When we study market structure, we usually rely on the chart's highs and lows to outline a range. But candle range theory introduces a different idea. Every single candle carries its own independent range. This becomes clear when we look at a daily candle on the 1-hour chart, where its wicks represent the hourly swing high and swing low, essentially forming a self-contained range within that candle. And even though this may seem like basic chart knowledge, once we incorporate smart money concepts, this single candle structure can provide remarkably consistent, high-probability trade setups. That's why in this video, we've broken candle range theory into 5 straightforward steps. So let's jump straight into step 1, how to apply candle range theory to identify tradable opportunities. The core framework for this strategy generally uses a sequence of 3 candles, each serving a unique purpose. Starting with the first candle, we have a bullish candle on the daily time frame, and from it we can interpret all the key price behavior. As we drop into lower time frames, we see this price action with increasing detail. But for this method, all the necessary market data is still captured inside that single daily candle. It tells us everything essential: where the market opened, where it closed, and the highest and lowest points it reached. Under candle range theory, these upper and lower wicks are viewed as isolated liquidity pools that subsequent candles are likely to target. This concept holds up when we inspect any chart. Most candles tend to reach for either the high or the low of the previous candle. So in CRT, the first candle simply defines the boundaries we want to trade within. The upper wick forms the candle range high, and the lower wick forms the candle range low. And in case you're wondering which specific candle qualifies, the truth is any candle on any time frame can be used to define a tradable CRT range. Of course, there are conditions that indicate whether a candle is ideal for this strategy, and we'll cover those later in the video. Now, moving to the second candle, this one determines whether a valid setup actually exists. The entire premise of CRT is that if price takes out the candle range high but fails to close above it, the next likely target becomes the candle range low. To visualize this, we want the second candle to break above the first candle's range high, then pull back and close inside the range. This liquidity sweep is essential. If instead the candle closes above the candle range high, the CRT setup becomes invalid, because the market is more likely to continue rising rather than reverse toward the range low. But if the second candle meets the criteria, then during the third candle we begin searching for an entry, typically a short, with the target set at the candle range low. You can certainly hold the trade longer if higher time frame structure suggests further downside, but once price trades through the candle range low, the CRT setup is considered complete. We've now explained the theory behind candle range structure, but we haven't yet demonstrated how it translates into an actual trade. So let's now drop down in time frame to walk through an example of how to execute this setup in real price action. Here we can see the price action of the first daily candle, along with the buy side and sell side liquidity levels formed at the day's high and low. And as we shift to the second daily candle, the first key detail to notice is the sweep of the buy side liquidity before price drops back into the candle's range. This matters because once the buy side liquidity has been taken, it usually suggests that the market is preparing to move toward the sell side liquidity next. So the liquidity sweep forms the initial phase of the setup, and the next structural element we're watching for is a change of character, shown when price breaks below the bullish leg responsible for the sweep. This indicates that bearish pressure is entering the market, exactly what we need for a short setup. And for the final requirement, we also want a bearish fair value gap to appear within this bearish move that produced the change of character, because this FVG becomes the PD array we will actually use as our entry model. So to recap, the first daily candle defines the range we want to trade, and the second candle provides the structural clues that confirm whether a valid setup is forming. This leads us to the third daily candle, where we can finally look to execute the entry. The approach is simple. We short from the bearish fair value gap, aiming for the candle range low as our target. It's also worth noting that many traders prefer entering on a break below the second candle's low, but breakout entries come with significantly more risk compared to using internal range liquidity. And beyond that, if we expect price to move lower, the fair value gap usually gives us a far more favorable entry point anyway. Once price eventually reaches the first candle's range low, the three-candle structure is considered complete. There is also a bullish version of this setup, built on identical principles, except this time we look for manipulation beneath a bearish candle's range low, targeting its range high. Now that we've covered the foundational concept of candle range theory, we can shift into step 2, understanding that a CRT setup does not need to rely exclusively on three candles. We use the three-candle model first because it's the cleanest way to demonstrate the idea, but in reality, there is no fixed number of candles required for a valid CRT setup. The number is irrelevant. What matters is that the market presents a clear AMD structure. To simplify the definition, AMD refers to accumulation, manipulation, and distribution, the three phases of the smart money power of three model. And it's during the distribution phase that we look for our actual trade entry, but only after the first two phases have been fully confirmed. When we examine this example on the chart, we can clearly identify the AMD sequence we're searching for. The first candle sets the candle range high and low as usual. After that, the next three candles show very limited directional movement, giving us the accumulation phase. Then comes the following candle, which produces a liquidity sweep. This is the manipulation phase we require. Just remember that this candle must close back inside the range. Otherwise, the bearish setup becomes invalid. Finally, the next pair of bearish candles push down toward the candle range low, forming the distribution phase that finalizes the setup. And this is where we would begin searching for an entry after confirming the manipulation phase. So the main lesson here is that the true focus of this strategy is identifying the correct market structure through the AMD model, not counting candles. And with this understanding, we can even identify setups that use only two candles. But to show how this works in practice, we need to examine this second candle on a lower time frame. And once we do that, we can clearly see another AMD pattern appear, starting with an accumulation phase, followed by manipulation in the form of a liquidity grab, before price finally drives downward during the distribution phase. And from a market structure perspective, we can see where price confirms a change of character immediately after the liquidity sweep, and then uses the bearish fair value gap as the mechanism that propels the move toward the candle range low. So the main point here is that time is relative. There is no predetermined number of candles required for a CRT model to complete. The key factor is making sure the correct market structure exists. So let's now transition to step number 3, which explains how you should pair timeframes to locate entries using CRT. Now that we understand the foundational ideas behind candle range theory, it's essential to highlight how we should actually prepare our setups with this method. For example, here we have a chart on the daily time frame, and as we can see, price has traded into this buy-side liquidity level. And using our understanding of smart money concepts, we know this moment is critical for determining whether price intends to continue higher or reverse lower in the form of a liquidity run or a liquidity sweep. This creates the perfect scenario to apply CRT to dissect this candle and understand what direction the market is more likely to take. And now with the candle's range high and low marked out, we know that if the next candle sweeps the range high, the probability increases that it will then seek the range low. But simply watching this on the daily chart doesn't reveal enough, because while it shows where the candle opens and closes, it doesn't provide the detailed market structure required to justify executing a trade. This is why it's crucial to remember that the higher time frame is only used to define the candle's high and low. Then we drop to a lower time frame, where we can actually break down the structure to determine whether a valid setup exists. This is what we refer to as time frame alignment, and we apply this concept to every type of smart money concept setup. For anyone unfamiliar, here are the ideal time frame pairings to use. As an example, if you are analyzing a monthly candle using CRT, you would then study the daily time frame for the type of market structure that might offer a tradable opportunity. And another example is that if you're examining a 4-hour candle, you should be looking for entries within the structure of the 15-minute chart. So moving forward, we arrive at step number 4, which is that when looking for entries, you should aim for the optimal premium and discount zones. As we've already discussed, every candle creates its own isolated range on the lower time frames, and this means we approach a CRT range the same way we would any other range. So when we are using a bullish candle to define our range, we are naturally preparing for a short setup, and this means we want to find opportunities to take entries within the premium region. The premium area includes all price action above the range's 50% midpoint, while everything below the midpoint is considered the discount area. So with this in mind, when we advance the chart to reveal the next 2 daily candles broken down on this lower time frame, this fair value gap becomes an ideal place to take a short because it satisfies all of our market structure requirements while also sitting firmly inside the premium side of the range. And on the other hand, if we are using a bearish candle to define our CRT range, we would then be looking for long opportunities, which means we should be searching for bullish setups within the discount zone, that is, anywhere below the midpoint of the range. This ensures that your trades are positioned with the strongest possible risk to reward. So now let's move on to step 5, which explains when CRT should and shouldn't be used. The principles behind candle range theory are extremely effective, but only when applied in the correct market conditions. For instance, here we have a bullish candle followed by another candle that sweeps liquidity above the candle range high. And at first glance, this might lead us to anticipate the third candle pushing lower to target the range low. But while this setup may appear valid initially, the key factor that many traders fail to consider is whether the setup aligns with the broader external market structure. So now that we zoom out and look at the larger range these candles belong to, a deeper analysis shows that this CRT setup is very likely to fail. The reason is that, for price to move down through the candle range low, it would have to break through a strong bullish fair value gap, which also overlaps with a bullish order block. So after evaluating the context, our directional bias should actually shift toward bullishness, the opposite of what the CRT setup would suggest. And when we continue forward in time, we see exactly that. The setup fails, as the strong bullish PD arrays provide enough buying pressure to prevent a downside continuation. Now moving on, we have another potential candle to use for a CRT setup. But in this case, the setup has genuine strength because it occurs at a meaningful point of interest, specifically a liquidity attack. And the way we should view candle range theory is as a tool designed to help signal potential reversals in price direction. This makes it especially useful during liquidity attacks, because it allows us to analyze whether price is executing a liquidity run or a liquidity sweep in real time as it unfolds. But remember, we must still evaluate the lower time frame structure to truly understand what the market intends to do. This is because we should never take trades purely from the higher time frame without confirming how structure is behaving underneath. Another powerful application of CRT is when price is approaching a PD array, such as this bearish fair value gap. The reason is that after a change of character occurs, we already have good reason to believe price may reverse from that area. So we can apply candle range theory to determine whether the fair value gap is actually being respected. The takeaway is that candle range theory can be an incredibly effective tool within your trading arsenal, helping you identify and trade reversals with precision. But it is equally important to recognize when the method should be used and when it shouldn't. If you found this video valuable, please leave a like and comment below which trading concept you'd like us to break down next.